It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's yet another fun-filled radio show with me, Jill Schlesinger. This is Jill on Money. I am your host with the most, hostess with the mostess. Mark is running the program, as always, and you are there, and we are here, and we're hoping that we can come together and help you take some of the mystery out of any aspect of your financial life. We are broadcasting live from the Capital One studios, and in order to help you demystify, in order to help you get to the next phase, whatever that phase is, moving forward, you've got to contact us, and there are easy ways to do it. Just send an email. Ask Jill at jillonmoney.com or go to our website, jillonmoney.com. Contact button is in the upper right-hand corner. And in the spirit of college football season, let us start the program with Ben. He's calling from Indiana, and I just like saying Indiana Hoosier, even though I think they're more famous for basketball. All right, next up, Ben from Indiana.
Well, thank you, Jill. It seems that I've gotten myself very confused, and so I need you to put your CFP wizard hat on.
Okay.
Look into your crystal ball and let me know the answer.
Okay.
So, my question is sort of an active-passive debate. I prescribe to the index fund passive. I like that a lot. However, through various podcasts, a few groups, and another certain radio personality, there's a strong argument for active funds outperformance, specifically Capital Group, American Funds, Prime Cap. And so, what's your take on it? Do you prescribe to the efficient market hypothesis? Is there outperformance?
Okay, so, I generally, if you listen to the show, you'll hear me talk a lot about index funds. And a lot of this has to do with my own experience, which is, by the way, I was a trader. It was like my first job on Wall Street. So I really was schooled and educated in this concept that you can beat the market. Okay, so that was like my bias coming in. And then when I was a money manager, I had stocks in account, then I had managed funds in the account, and I moved those funds around. And then I really started to get into the index fund universe. The reason I bought into it, I believed that I was spending too much time thinking about squeaking out 0.5% a year better than the index, rather than the more important prospect of how do I help people save and make more money in their whole financial lives. So that was my bias coming in, all right? That said, the research does show that index funds generally do better for investors over time than managed funds. Can you find certain funds in the American funds universe that have done incredibly well? Absolutely. I used to love the American funds, as a matter of fact. So your question is more about, if somebody came into me and they said, I already own these American funds. I've paid the freight. I've paid the commission. I work with someone who, whose commission helps pay for all of my financial planning. And there's a bigger story there, then I'm fine with it. But if you, Ben, are just managing all of your money and you say, should I just have a portfolio of passive index funds? Generally speaking, I'm going to say, yeah, because I think that, number one, you're less likely to shoot yourself in the foot. And number two, the money that you spend on that commission will fall to the bottom line. So did I confuse you further?
No, that you reinforced what I thought that I agreed with.
Then we win. No, so tell me about your situation exactly. So what's going on for you?
So, we're doing well. We're 40, 42, got a couple kids. We're pretty squared away. We're socking away money in our retirement funds. We just paid off the house yesterday. 529 accounts are mostly already funded. So that's kind of where we're at now. But
so who would have sold? So who will sell you those American funds? How would you get access to them?
They would be in our retirement accounts, or like an IRA. I have a Vanguard IRA, a Roth IRA, and so I'm on a Facebook group, and there's some intelligent people, more intelligent than I am, and they advocate for Capital Group, and they keep talking about their they have a strong structure to them, and their multi investor approach, and specifically prime cap. They say so. They recommend going through your IRAs into those funds.
Yeah, but you have to pay a commission to get in, right? I mean, I feel like there's a lot of navel-gazing around like, oh, it's a well-structured this, that, and the other. It is. I'll give you 2 managed fund houses that I like. American Funds is absolutely one of them, okay? So the Capital Group. And the other is called DFA, Dimensional Fund Advisors, DFA. And same thing. These are funds that are purchased through an advisor. But, the difference with DFA is that they are very low cost. They are meant to provide management for people working with an advisor so that the cost of the investment is extraordinarily low, and you then pay your advisor an asset under management fee or a flat fee. So if you're managing your own money, at the end of the day, I just wonder, and you sound like you got your act together. I don't know, like it seems like extra work for not much more return. So yeah, if you said to me, "Oh, I've got capital funds inside of my 401k. Should I use it?" Yeah, you could use it. Like throw it in there. Put some money in there. Why don't you make that your large cap position and see how it does versus the index? And hang in there.
Okay.
But don't go crazy. You've already done the hard work. You know what the hard work is? Saving. The hard work is living within your means. The hard work is not blowing it for yourself. That's really what your hard work is.
Now, let me give you a little perspective on the funds offered. So the 401k, our 401k is great. We have some super low-cost index funds, and I think we're all indexed there, so like 0.05%. My 403b, the American funds are run around 0.95%, almost a full percent, whereas we just got our first index fund, and it's a total market. It's not a Vanguard. It's a TIAA CREF, but it's like 0.3%. So 0.3 total index versus almost a full percent for the American funds. Is it worth going with American funds, do you feel?
You're not going to go wrong. And if you want to run your little experiment, you can do it in real time. I would just pick the TIAA index fund and not worry about it. Because, again, you're right. There could be years where American funds beats it. There could be years there where the American fund lags it. You know where you're going to make more of your money is really on your top line allocation decision. Okay. How much money going into stocks, how much going into bonds, how much going into cash. You've got TIAA CREF, right? One of the big advantages to having TIAA CREF is that you actually have one of the few annuities that works. So you have a fixed account on the TIAA side that kicks the butt of any bond fund that you're ever going to find. So I will tell you right straight up, the best thing you can do in your TIAA CREF account is use the fixed account on the TIAA side as your bond position, and don't look back. Don't even worry about it. All right. During the break, you've got a big assignment. Now that you've bookmarked the Jill on Money website, you need to sign up for our weekly newsletter. It's weekly. The free weekly Jill on Money newsletter. Do that during the break, and we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You are back. It's Jill on Money. And if you've got a financial question, we'd love to hear from you. Ask Jill at Jill on Money. That is our email address. Our website is jillonmoney.com. You can click the contact button if you would like. A lot of people heading into the last 3 months of the year. And if you are considering a career change, or you're considering asking your boss for a raise because you hear the labor market is really tight and Amazon's got 30,000 open jobs and a bunch of holiday hirings coming up, got to do a little research. Got to make sure you know what you want. I always think it's a good idea to pick up a little side hustle, especially as you come into this end of the year. But if you really are considering a career change, check out the blog post. I wrote one just for you. Career Change 101. And it's going to require some work on your part because I walk you through some steps and some ideas, but you really have to be serious here. This is no fool. You don't just go out and on a lark. Take it seriously, and you just may find a better opportunity. Okay, let's get back to your calls. Next up, John in Houston. John, welcome to the program. What can I do for you, sir?
Hi, Jill. I am so excited to talk with you today.
All right,
so
me too.
I have what I think is a good problem. I have some money, extra money that I don't know quite what to do with. I had a rental property that was my bachelor pad before I got together with my husband that we sold 2 weeks ago.
Congratulations.
Thank you very much. I was tired of being a landlord, so done with that. So we received $75,000 from that sale. I have two options that are kind of obvious with what to do with that money. We, on our primary home right now, we have our primary mortgage, and then we have a secondary mortgage. We split it to avoid a jumbo loan when we bought that house.
Okay.
My other option is my mother's retiring next May, and her remaining mortgage is about $75,000 as well. So my husband and I have talked about helping her out in either paying off that mortgage or buying her house as she heads into retirement.
Couple of questions. Let me just ask before. Let me just pop in here. You said you've got two separate mortgages on your primary.
Right.
What are the interest rates on those mortgages?
So on the primary loan, it's 3.75.
That's good.
Yes, I'm happy with that. On the secondary loan, it's 5.24.
Yes. Okay, I don't like that one as much.
Yep.
All right, tell me a little bit more about yourselves. Are you guys both working?
We are both working. The caveat to that is my company is in the process of being acquired. Actually, it'll close next week. So there's a question mark on my job. But I don't really have any information either way. I could be here for a year. I could be here for a few months.
Okay.
So that's a big question mark right now.
Emergency reserves to cover you if you do get bumped?
Yeah, we have about $100,000 for an emergency fund.
That's good.
The other thing that we have going on is we have one child, and we're in the process of a surrogacy journey for a second. So we have major expenditures coming up with that over the next year, but we do have about $60,000 set aside to cover those.
Okay. Is that enough? Is 60 enough to cover?
It's enough.
Okay.
Yeah. Worst case scenario for that, it'll probably be worst case is 90,000. So we have at least enough to get us most of the way, and they're staged out, not all at once.
Okay.
So if we get into a situation where we need more money, we can find it.
Would you, if you were to lose your job, do you feel comfortable and confident, I don't know what field you're in, that you could get another job fairly quickly?
Probably within 6 months. If I do get let go within the next year, there is a severance package involved, which will give us a few months of a buffer as well.
That's great.
Yep.
How about savings for both retirement and for the kid you already have? Do you have any college savings set aside so far?
So for retirement, we have about $630,000 in 401k and IRAs.
That's great.
Thank you. And in just a brokerage account, we have about $400,000.
Okay. And how old are you guys?
I'm 36 and my husband is 37.
Mark's saying you're in great shape. He's like, why is the guy on the phone? What's happening here? Okay. Now let's dive into your mom's situation right now.
Sure.
Is she financially in need of your assistance?
So I reviewed her retirement stuff with her. She works for a school district, so she's on teacher retirement. She's going to replace a good portion of her salary, so she will be fine.
Okay. So that would just be like, you would be like, I want to be the favorite child because you're going to pay off on it. You want to basically make that. Yeah. You're going to make that like the indelible mark that, of course, your mother probably already favors you, but now she'll favor you even more. Yep. I get it. Okay. Yep. But she's okay, right? She is okay?
Yeah.
Okay.
She'll be fine. Yep.
So you got a ton of money that's set aside. Got $1 million bucks basically, right? That's great. I'll tell you what. This is going to be a boring piece of advice, but I think it works. If you consider this, that secondary loan, right? If you said that your hope was that you were going to pay that off just, let's say, over the next 10 years, right? You said, I really want to chip away at that. that would be like a decent goal. I would really be interested in you paying that whole thing off in one fell swoop, because essentially what you are doing by paying that secondary loan off is you are basically earning 2 full percentage points more than you would investing in a 10-year government bond, right? 10-year government bonds, they yield about 3.25. Your rate is 5.25. You essentially have a way to take money and get risk-free return 200 basis points, 2% more than the 10-year Treasury. I don't know many investments that give you a guaranteed better return with no risk. And I think that is kind of fabulous. So it's just weird. The money kind of matches up. But also, I mean, I would not give you this advice if you didn't have that big fat emergency fund. I really wouldn't. I would say keep that money, make sure that, you're going to pay for the surrogacy. But it sounds to me like you've got a good emergency reserve. You got the money set aside to get that second kid. You've done a terrific job saving for retirement. I guess the only other piece of advice I would have is that if you have those proceeds from the rental property, just make sure you don't have a weird tax hit next year. Because sometimes rental properties can ensnare you in a tax situation where you're recapturing depreciation that you took during the life of owning that property. So before you pay the whole thing down, just double check. Do you have a tax preparer that you work with?
I need a new one. I fired my one last year.
Nice. Yeah. Fire. Okay, so when you're looking at maybe before you pay off that second mortgage, then I would just double check to make sure that you're not going to have some scary tax burden come next spring. But otherwise, I think you're in great shape. And even if, by the way, even if you had to keep $25,000 available for taxes, take the 50 and pay down the 5.25% loan. Yeah.
I mean, my biggest concern was with kind of some of the uncertainty in our life was moving liquid money to non-liquid money.
Yeah, I mean, I would say that also, except that you got $100,000 that's banked.
Right.
I mean, if you're feeling weird about it, or if all of a sudden you're like, now, I have a little bit of anxiety, then don't pay it all down at once. See how the next year goes.
Right.
You're not moving anytime soon. You're staying where you are?
No, yeah. We've been in this house for 2 years, and we're going to stay unless a major life situation changes.
Yes, God forbid. But I think you're in good shape. I really do.
If I do in the future decide to buy my mom's house, have you dealt with a situation like that? And I don't know quite how to approach it with either paying off her mortgage or actually buying her house. Those are two different.
Why would you do this? I mean, like you've just said to me, she's okay financially.
It just would make her life a lot easier if she didn't have the mortgage payment.
I mean, you can do an agreement with your siblings where you say, I am going to pay off mom's mortgage for her just to make her life easier, and therefore I want to get a bigger piece of this house when it's sold. But I wouldn't do anything without actually talking to them about it and maybe making it part of a larger conversation about estate planning for mom. We will be right back. During the break, here's your next thing to do. Why don't you order my book? You can buy the book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. It's right there on the website, JillOnMoney.com. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. And if you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. You can also head over to the website, jillonmoney.com. We've got a contact button there. We've got resources. We've got great stuff to read. You can listen to old shows. Check out our newsletter, which is awesome. You click right on the old newsletter link and boom, sign up. Very easy. Free. It's free. Did I mention that? Okay. Let's do some emails. This is a note from Maria, who's 41 years old. She's an immigrant. She says, my parents have absolutely no money to help me with anything. I moved to the United States, got my PhD in computer science in 2017. How about that? and she works for a big tech company. She went to a private university. She took on $60,000 student loan. $27,000 is still unpaid. So she's 41. She's got $27,000 of student loan debt and $10,000 of credit card debt. And I am focused on paying these off ASAP. But she writes, I'm scared. I'm scared about retirement. I'm scared about getting sick. If I don't work, I'll be homeless. I have no one to help me financially. I have no place to go. I need help figuring out my life. I'm very frugal because I want to pay off my debt and start saving, but I can't wrap my head around financial matters. All right, so let's start small here. First of all, you didn't mention how much you earn, but you got a job, and it's a big tech company, and that's great. So the first thing you're going to do is you say you're living frugally, but you look at how much money you're spending, and you try to allocate some money every single month, a little extra, just scrape it up to pay down that credit card debt first, and then you make at least maybe even like a little bit more than the minimum payment on the student loan. I also wonder, are you using your retirement plan at work? There's probably a matching component. This is a huge company, so maybe you just go put money into the matching part of it, maybe up to 6% of your salary, and then you're doing exactly what you should be doing. And don't freak yourself out. You can only do what you're doing. You have a job, you are employed, that's great, and you're going to the only thing you have to wrap your head around is paying off these two loans. And if you could, put a little bit of money into your retirement account through work. That's it. And going anywhere else from there is just making yourself crazier than you need to be. Okay? Good luck. I'm so sorry. It stinks. Okay. Carolyn says she's been married for 34 years to her husband. He's 58. I'm 62. We've got no plans to retire anytime soon. Thank goodness. But I've been planning to go to 3 days a week. My husband works half days in the summer to help our youngest son on the farm. He has no interest in our company. Our oldest son does work in the company. He's 31. Several years before we turned it over to him, we started out with nothing. We've built a successful business for the past 25 years. We've always been conservative. We have invested in land, 401k, mutual funds, index funds, and CDs. The last 2 years, our income has been over, you ready for this, gang? $1 million per year. This is, by the way, when we get those nasty comments sometimes on social. They're like, "Oh, why do you take questions from people who make $1 million a year?" Relax, guys. It doesn't. So he has $1 million a year. I'm not saying he's better or worse than you, or she's better or worse than you. They emailed us, so we're answering. Okay. Here we go. Back to the email. We decided to find a fiduciary financial advisor. He has a show on the radio station, and we only had 2 questions for him. Have we made wise investments, and should we switch from a 401k to a Roth IRA? We gave him a list of all of our investments. We met with him several times, usually for an hour or more. He never answered our question about the 401k. He said he thought our other investments were okay. Once he found out we had over $3 million in CDs, he was focused on those only. He wanted us to cash in all of our CDs and invest it all with him. When we told him that we only wanted to invest $750,000 initially with him, his demeanor changed and said that maybe he was not the right financial planner for us if we did not trust him, and that maybe someone else would be a better fit. I said that we didn't really know him and that we are not going to dump $3 million with him. We wanted to test the water first, and I was okay with not investing with him at all if that's what he wanted. He said that if he were our financial advisor, we needed to take his advice. Then he rushed in his assistant to get us to sign papers and took the $750,000, but did not invest it the way he suggested we invest the $3 million. I tried to check him out, and everything looks legit, but I think we need to meet with another advisor. What do you think? Is it common for couples who have more than one financial advisor? Our net worth is a lot. I'm not even going to say it because it's going to piss off these people who are listening who don't like when I have rich people who have questions. But it's a big net worth. It's, because it's land. This is a fascinating question to me. I'm going to tell you something. When I was a financial advisor, I know I was that guy. I have felt that feeling. I may not have said anything, but I think that many financial advisors believe it takes as much work to manage 750 grand as 3.75 million. And there is, I think that they feel conceptually that, you're either going to hire me or you're not going to hire me. So early in my career, I can tell you that I probably did something like this to somebody. But you know what I learned? It's really about the client. It's not about me. Now, some firms have minimums. If this guy, he obviously doesn't have a minimum. There are some companies that won't deal with you unless you have a $2 million minimum. But what I would say is this. If you have a bad feeling about this guy, there's no problem. You can get another opinion. That's certainly not an issue. But I also think that he may not be stylistically the right guy for you. You may want to deal with somebody who says, you know what, look, maybe you don't need me at all. I bet if he said that to you, you might have given him the $3 million. So I think that if first things first, if he didn't invest the way he suggested you invested the $3 million, the question is why? And if he doesn't have a good answer to that, then you really probably do need to find another advisor. But I think that if you'd like, let's follow up. Mark, why don't you, let's send him some names. Let's send him our friend in Rhode Island can maybe help them electronically and give an overview. I would get a second opinion for sure, especially because you feel weird about this whole thing. Okay, you are listening to Jill on Money. Don't be mad about the millionaires. Be mad that nothing. Don't worry about it. It's just money. Pretend it's $10,000. Same questions, okay? If you would like to get on the air with us, ask Jill at jillonmoney.com is our email address, and our website is called jillonmoney.com. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You are back. It's Jill on Money, and it is an email marathon session. So we're going to get going with your questions. Juliet writes, I want to know what to do with a lump sum of money earned through the sale of a company. I have a large sum. It's sitting in a low-interest savings checking account, but I feel skittish about putting anything more in the market right now. I did put some money in Wealthfront in a high-interest savings, which is just under 3%, some money in Betterment, just under 3%, and some in Vanguard index funds. I still have more that I need to do something with. Long-term goal is great life during retirement. I'm 47 right now. 47's really young. So I don't know what else you have in the market. Maybe that's the question. Maybe you have a lot of money in the market. I guess that you could do some laddered CDs, some longer term CDs to jam up the interest rate, but it's not going to be much better than just under 3%. If you just feel like you absolutely do not want to do this, have any money at risk, the options are limited. So I think that's what you're going to find. I would much prefer you treat this money as part of your overall net worth, your overall portfolio, and then really allocate it, even if it's just a conservative portfolio, some money in, low cost index funds. But I don't know, like 47, you got to imagine you could have another 45, 50 years ahead of you. And so maybe the market being volatile right now shouldn't really bug you. Anyway, we'll see what you think about that. Second question, what is the best way to start giving money to my kids? Set up some small investment accounts for them, but I'm wondering if there are other options I should consider. You don't mention how old they are. You can do trusts. You can do 529 plans for college. I don't know if you have that already. Or you can just do a supplemental brokerage account. And I'm not, again, I don't know how old the kids are. It really depends. You can just gift outright to them, and we can give anyone $15,000 a year. So I need some follow-up, Juliet. Wherefore art thou, Juliet? I'm sure she's never heard that. Right, Mark? Kenneth writes, I'm 60 and a half years old. I'm retired. I have annual income of $10,000. I've got $70,000 in a Fidelity Freedom Fund, and I want to protect that $70,000 from a possible downturn in the economy. Fidelity says they will roll it over into a IRA and will and I can pay them 1 to 1.5% to professionally manage it. They've got an alternative IRA for a lesser fee. This IRA comes with little or no management. My uneducated view is to remain in the so you've got it. You've got a 401k. Okay. Yeah, stay in your 401k. Why would you pay them a fee? Forget about it. If you want to protect from a downturn, that Fidelity Freedom Fund is not. It's the Fidelity Freedom 2020. I'm sure that it has pretty low risk in it at this point. So I no, you don't need that. Question: is it a good time to move some investments into bonds? Well, I mean, that's a crazy question because you have to think to yourself, anytime's a good time to buy a bond or a stock or anything as part of a larger portfolio decision, as part of an overall game plan. Bond prices are actually high after all the turbulence in August, but you know what? It doesn't mean you can try to figure out where the top and the bottom is of those markets. So, yeah, I mean, it's a good time to reevaluate where you stand. That's what I would say. It's okay to do that and then see if everything lines up the way you think it should. Reevaluation is always good. Steve writes, "Hi, Jill. My father has always had his taxes done by an accountant who has a practice near where he lived in New Jersey. My parents are now both in their 80s, and due to health issues, we had to get him and my mother moved out of their home and into an independent facility closer to where their children and grandchildren live. My sister is trying to get his tax records from previous years from the accountant. The accountant refuses to answer her calls and emails." What? Are your parents, is it because, I wonder if he has, I wonder if he's saying like it's not your parent has to do it. Maybe you have to get one of your parents on the phone to request it. The question is, do we have any legal recourse to get the accountant to hand over the tax records from the past years? I don't know if you have legal recourse, but I think that what you could do is you probably could go to the AICPA if this person is a CPA and probably make a complaint. But I would try to get one of your parents on the line with you guys and calling. And if that doesn't work, we'll have to go into plan B. But I would try to make a complaint there. Kate says, my spouse and I are planning on buying a house in the next year. We're getting some help with the down payment from family. What's the best way to handle the money for this? Are we subject to taxes on it? Depends how much money. So if your family wants to give you a check for $15,000 and your spouse a check for $15,000 and it's in your name, they may have to also sign an affidavit. I remember that's now, after the whole housing boom and bust, that some lenders want to know where the money came up, where you came up with that money, where it came from, the source of funds. But that's the way to avoid taxation. If they give you more than $15,000 each, that would change the scenario. If you've married parents who are going to do it, they can give you $30,000 each. So depends how much money we're talking here. All right, you are listening to Jill on Money. And if you'd like to follow us on social, Mark has everything all set up. Our handle is @JillOnMoney pretty much everywhere. Twitter, Instagram, Facebook, YouTube, you name it. Head over to our website, JillOnMoney.com. We got a great resource section. And tell us if you've got something we need to add to that resource section. Let us know. The contact button is right there on the website. Jill on Money. We'll be right back. You're back. It's Jill on Money. And before we close out the hour, let's do another email. This is from Will in Texas, who says, I've owned my home for 15 years, and I'm now considering selling it in this hot real estate market. He lives in Austin. He said, I paid around $200,000 for it, and I expect to be able to sell it for around $600,000. Jing, jing, jing. So I would make over $350,000 over the cost basis. Given that I'm single, my understanding is that only the first $250,000 would be tax-free. True. The rest is long-term capital gains. Any way for me to reduce the taxes on this? Well, did you do any work on the house? Like, did you improve it? Because you can raise the cost basis on your house if you can say, I'm not talking about improve like I painted it, but I bought a generator, I added a room, I have built-ins, something that is a driveway, new roof. Any of those things will increase the cost basis. Short of that, you got to pay, Will. I'm sorry. That's just the way it is. And it's not terrible. You'll move on. I'm interested to find out what you're going to do next. Are you going to buy another house? Kate writes, my spouse has 2 workplace retirement accounts and a pension fund. I have 4 separate retirement accounts. I know it seems like a lot. We're in our mid-40s. What's the right allocation for us between all of these? Guidance is all over the place. Guidance is all over the place because so much of this really depends on who you are, your view of risk. In general, when in doubt, this is what I would say. If you are in your mid-40s and you're not going to touch this money for at least 15, 20 years, if you really like risk and he doesn't really like risk, maybe you just go right down the middle, that you maybe are growth and maybe he's balanced. There is no one formula. What you need to know is the right asset allocation is the asset allocation that you guys feel comfortable riding out, good times or bad times. So good luck. If you want to call back, we can chat a little bit more. And before we close out the hour, I must remind you that we are broadcasting live from the Capital One studios right here in New York. When we return, we're going to get to more of your questions. You can send us an email, askjill@jillonmoney.com. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money. Thanks for joining us. Jill on Money is very excited because we are broadcasting from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. September, Life Insurance Awareness Month. May want to go to policygenius.com. Check out if you got what you need. Wouldn't that be smart of you? It's really hard to talk about insurance and get you excited, but come on, you got to do it. All right, we're very excited because we have a great guest today. Her name is Cynthia Loh. She is the Vice President of Digital Advice and Innovation over at Charles Schwab. And, we talk a lot about other alternatives for folks who are looking to have their money managed. Well, Cynthia has a lot of ideas for you. So here is our interview with Charles Schwab's Cynthia Loh. Cynthia, welcome to the program. Thanks for joining us. So tell us about why Schwab entered the whole universe of digital advice and digital money management.
Schwab entered into the digital advice space in 2015. We launched our first robo, which was Schwab Intelligent Portfolios, which really is an automated investing solution that has no advisory fee, but you can get sort of 24/7 help from chat. And over the next couple of years, we launched an add-on to that, which was Schwab Intelligent Advisory, where you can get unlimited access to CFPs. And over the course of the last 4 years, that platform has grown to over $40 billion. The whole premise is that we are able to leverage technology to make finance and investing much more accessible to our clients, and our clients have responded very positively.
So let's say I'm a Schwab client, and someone just called the radio show recently about this. They said, I'm a Schwab client. I'm managing my own money. I use ETFs or index funds. Is that a person who is not necessarily the right match for the intelligent portfolio, or is that somebody who is the right match? In other words, if they're doing it themselves, why do they need you?
I think the way that we've sort of envisioned robo is that, technology has come a long way in the last decade over the course of the evolution of robo products. And really, robo is going to be, over time, more about just using technology for the things that it can do better so you can free up your time to do other things. I've heard so many client stories about how they have their spreadsheet open and they're doing these investments and trades. Well, now you can actually use tech tools to screen for low-cost funds, to automatically rebalance your portfolio to the right risk level, to do things like tax loss harvesting, where you can sometimes report a gain on your overall portfolio but actually have a tax loss. And so really the idea, and we have many of our clients that have done it themselves previously that opt to use digital advice for that very reason.
Let me ask you a question about rebalancing and tax loss harvesting. There are some robos that are out there who basically are doing auto rebalancing and or tax loss harvesting on a daily basis. Now, you, smarty pants, are a chartered financial analyst. What is the proper amount of rebalancing that just average Joe? I'm not saying I'm a hedge fund looking to squeeze pennies out, but how often should we be rebalancing?
I don't think there's an exact time that's a fit for everyone. If I said daily or monthly or quarterly, that wouldn't necessarily fit for any individual investor. I think the important thing is to be able to monitor on an ongoing basis, which is what technology will allow you to do, what your risk levels are or when there is opportunity. So instead of sitting in front of your computer and monitoring, gosh, I wanted that, call it a 60-40 equity fixed income portfolio. And when that drifts, what's the appropriate amount for it to drift? Like, there are so many tech tools at folks' disposal now that they can leverage to be able to do that automatically for them.
But I imagine, isn't there research? Because I swear, like 100 years ago when I was still an investment advisor, there was a certain amount of research that was done weighing the difference between monthly, quarterly, and annual. And the difference was not vast. So is there research that shows the difference between how often one rebalances?
There definitely is research across that, and I think there are differing views.
Right. So what's the view at Schwab? Like if I'm a client at Schwab and I use the intelligent portfolio, do I set a rebalance or do you have a default of when you rebalance or how often?
So we have a default on how often you rebalance. The idea with Schwab is that we're going to take care of it for you. Mm-hmm. So we will automatically rebalance your portfolio as needed and based on certain thresholds of where your risk levels go.
So you don't do it on a time basis. You do it on a percentage from your ideal allocation, right?
Make sure that you maintain your appropriate risk levels. That's correct.
Okay. So what is that? What is that differential? I'm a 60-40 investor, 60 stocks, 40% bonds. What is the default? When will the portfolio be adjusted on my behalf based on that allocation?
We'll reallocate your portfolio on an ongoing basis. And once a year, we'll look at your portfolio, also looking at what your expectations are what our expectations are for each of the various asset classes. For example, like gold, if you have gold in your portfolio, we would look at our expected 10-year forecast of gold in your portfolio. And if that's changed on an annual basis, we might rebalance on a risk level for that too.
Got it. Perfect. Okay, we're done with rebalancing. I was a little weedsy. I'm sorry. Here's my question about the advice product that you have. Is there a minimum amount that I need to have in my Schwab account to qualify to get advice via a CFP?
There is for our digital advice. Maybe I'll take a step back and just talk about our overall digital advice platform.
Yeah.
So I mentioned we sort of started out in 2015, and our first product is Schwab Intelligent Portfolios. And what this really is we build, monitor, and automatically rebalance that diversified portfolio. There's no advisory fee, and it's a $5,000 minimum. So you answer a series of questions around a goal, and then we put you into a model portfolio based on that goal, and we take care of sort of the technology and automatically rebalancing it for you. The other product where you're asking about the unlimited access to CFPs is our Schwab Intelligent Portfolio Premium offer, where you get sort of that same underlying portfolio as Schwab Intelligent Portfolios, plus you get a much more sophisticated digital tool as well as unlimited access to CFPs, and that minimum is $25,000. And we recently changed the pricing there from an asset-based fee to a flat fee. So it's one-time planning of $300 up front and $30 a month on a subscription basis following that.
Okay. We are going to be right back. But while we're on break, why don't you do something useful? Go to the Jill on Money website, jillonmoney.com. You can listen to past shows, or if you've missed any part of this one, you can read, listen, watch. It's so much to do. You can check out our resources. You can also sign up for our free weekly newsletter. Free, gang. That's free. And don't forget, you can always subscribe to our podcast, Jill on Money. You can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcasts. And while you're there, if you have a question, just hit the contact button. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And if you've got a financial question, we want to hear from you. Our email address is askjill@jillonmoney.com. And, we have a sister podcast. Coincidentally, the name of that podcast is Jill on Money. You can get it on Apple, Stitcher, radio.com, Google Play, anywhere else you find your favorite podcast, or you can just go to our website, jillonmoney.com. By the way, for those of you who sent us notes after the Federal Reserve cut interest rates, complaining, carping about how you're bummed that you got lower interest in your emergency reserve funds, why don't you go out and look around a little bit? There are tons of opportunities. I always talk about this website called depositaccounts.com, depositaccounts.com, bankrate.com also has this, where you can go onto the website and say, where are there better yielding checking accounts, savings accounts, high yield money market accounts, short-term CDs? You don't have to take this lying down, is what I'm saying. Okay? So take some action. And just as we go back to our interview, I also want to point out that so many of you write in and ask me questions about fees that you are paying your financial advisors who essentially just ghost you. They go away, or you only see them a couple times or hear from them a couple times a year. If all that you are getting for 1 or 1.5% a year is someone managing your money, then you need to pay attention to our guest, Cynthia Loh. She's from Charles Schwab, and we're going back to our interview with her. She is the Vice President, Digital Advice and Innovation, and we're going to talk about the different options that places like Schwab are making available to all of us. So here's the rest of our interview with Cynthia Loh.
So the folks in the unlimited planning, I would say there's many similarities across both of them, but the biggest probably couple differentiators that we see in our Schwab Intelligent Portfolios Premium product is their investment experience tends to be less, so they're less comfortable with financial concepts and planning, but also there is a actual event occurring in their life. So they're at the moment where they're ready to start thinking about retirement planning, or they've just had a new baby and they're looking at the best way to save for their long-term college education or that type of thing. So really getting that advice for change in their financial picture or something that they've started to think about more heavily tends to be when folks gravitate towards our premium product.
I'm wondering also with the advice via CFPs, do you get a dedicated CFP or whoever answers the phone?
So you get a team of CFPs. So you can request to get the same CFP again, but really is a team of CFPs that are serving your needs.
So you've now been in the investment world for how long?
Oh, man.
Go back in time, girl.
Off and on for close to 20 years.
Okay. When I've interviewed some people at the traditional wirehouses, it could be Merrill Lynch, it could be Morgan Stanley, it could be UBS. They totally poo-poo the whole robo-advice. They consistently will say to me, yeah, Jill, that's fine. These are teeny tiny accounts. when people have real assets, they want a dedicated person who they can talk to and know that they can get to. What is the answer to that as a pushback against this model?
There are so many different types of clients, right, that are investing. And hopefully, with the advent of robo-tools, even more people have access to investment and planning. And I think there is absolutely a segment of the client base and the investing population that is looking for a dedicated one-on-one relationship where they go in and are able to sit down with an advisor face-to-face. And Schwab offers that.
Right.
We're a full-service wealth management firm. I would say there are also other clients, and you see this, again, in the consumer space as well, where people are much more comfortable with technology, and they want virtual, and they're comfortable with a team-based approach. And so what I would say is, the number of assets under management in digital advice continues to grow. I think we're at about $250 billion today and could reach $500 billion in the next 5 or so years if it continues to grow at the current clip. So the other thing I would say is, robo today is defined as a specific category of, typically low-cost ETFs, passive management, a diversified portfolio. But I can also see a world over time where, robo is really just about leveraging technology. And why wouldn't any investor want to leverage tech tools to help them manage their portfolio?
Yeah. I mean, look, I'm a big fan of the model, and I think that a place like Schwab or Vanguard that already has the type of person who might be engaged in managing their own money, or like you said, look, you could work for an advisor at any of these places, that this was the game changer when you and Vanguard entered that market. The robos that have not yet sold, did they miss their window of opportunity? Like, I remember LearnVest sold to Northwestern Mutual for a huge number, hundreds of millions of dollars. It seems like they didn't really get that much for that. On a valuation basis, have some of the smaller robos missed the chance as big players like Schwab and Vanguard and even some of the wirehouses have their own platforms? What do you think is the assessment of valuation today?
I think it will be very interesting to see over the next 5 to 10 years, but I think certainly there will be more consolidation. There will be less players than you see today.
Thank you so much to Cynthia Loh. Don't take it lying down. Take some action. Okay, let's do an email. This is from Anne, who writes about investing the proceeds from the sale of a home in New York. She writes, "Hi, Jill. My husband and I are early retirees. He is 57. I am 48. I know you don't love that, but it works for us." I have to tell you, I've got to get less judgy about this, Mark. I really do. Because obviously I'm saying things on the air like, what are you going to do with yourself? But, a lot of people will do fun things and they'll figure out how to be productive. I'm happy if you're happy. How about that? Just remember, you got a long life ahead of you, though. Look at in Anne's situation. She's 48. She's going to have more years in retirement than she will have had working. That's amazing. Okay, let's get back to Anne and get off my editorial. We recently sold our co-op in New York for $760,000. We don't have a mortgage. We're wondering, how should we invest the amount in light of the potentially looming recession? Okay, so here's the facts. Net worth is $3.1 million, with about $1 million in a brokerage account, $1.4 million in retirement accounts, very little in bonds, and the rest in our recently sold apartment. Okay, so now, here's what we got. So just keep that in mind, guys. So there's $2.4 million. That's the nest egg outside of the real estate. Now, Anne says, we expect to buy a home in Texas for $250,000 to $300,000. That's a great trade. Okay, so they're going to have $450,000 to add to the portfolio. So there will be essentially $2.85 million in assets. Question. Bonds don't seem to be a great investment right now, given interest rate movements and the current yield curve. So is the best bet an online savings account that yields just over 2% or just below 2% or something else to help us protect and grow this money? Well, I mean, okay, let's go back a second. In my mind, it is really hard to cherry pick what exactly you are going to do with your money, like this particular segment of your money, without understanding what's going on with the rest of the portfolio. I don't know if you guys are managing the portfolio or someone else's. But let's just say that the 450 added to the 2.4 should give you about 85 grand a year in income. And I guess I'm wondering, number one, is that enough for you? Can you live on 85 grand a year? Maybe you can. Just let's go there. That's a 3% withdrawal rate. If I knew a tiny bit more about how much you need to spend, we could make different decisions about the 450. But the general idea here, Anne, is that you would need to have a larger game plan. And if you need to hop on the line with us to talk about that, you would put the money to work to get the game plan working for you. And so that may include buying some bonds. But if you really hate the bond market, sure, you could have some short-term instruments. But over the long term, you're going to want some bonds. All right, it's Jill on Money. If you've got a financial question, send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back. It's Jill on Money. You guys should just be happy that I am not inflicting upon you my passion and deep dive into the details of Brexit. Because I cannot stop reading about it. It is, maybe it's one of those things where if you think your own government stinks, it's nice to see that someone else's government is like also in complete disarray. Not like, I'm not being political here. I'm just saying the inaction. Anyway, you are listening to the program that takes the mystery out of your financial life. Please refrain from sending nasty emails to that comment that I just said. Okay? We're just talking about paralysis at the government level. Okay. If you would like to get on our program, send us an email. Ask Jill at jillonmoney.com or go to the website, jillonmoney.com. We are coming into almost the fourth quarter of the year. That means the end of this quarter, end of September. This means this is your opportunity to look at all of your investment accounts and make sure that things are properly diversified and make sure that you are not getting ahead of yourself. Meaning that if things are looking good in one asset, don't say, I'll just leave it in there because it's doing well. Stick to your game plan. Keep looking at that diversification. Make sure that your asset allocation plan, that you have what you want in each asset category. There was also recently an article, Mark, which I thought was interesting about the ideal number of mutual funds in an account. Mark just snarled, I think. It depends. But what was interesting, of course, when they do surveys about this, they find that people have a gazillion funds, including idiotic brokers who somehow think that more funds means that somehow signals to your client that you're smart. I think 4 is fine. I think a cash, a bond, a U.S. stock, and an international. Here's how I could add a few more. I could add emerging. I could add a commodity. I could add a REIT. I could get to like 7 or 8 pretty quick. But that's it. I don't see much more. That seems fine. Did you just make a note to yourself to add a REIT to your account? All right. What was that note then? Okay. Here's from Susan. Jill, my husband and I are 60 years old. He's self-employed, and I work part-time outside the home and for him. We have about $500,000 saved, but not invested in an IRA or anything. We have other assets, our home, his work condo, shop, cars, equipment. What would you suggest we do with some of our cash so we can see some growth? CDs, something else? My husband plans on working for at least another 10 years. I hope so, because $500,000 is not that much money. I mean, I don't know. It depends how much you actually spend, but okay. First and foremost, go to the website, jillonmoney.com. Click on the September 9th blog post that says Retirement Plans for Self-Employed. This is probably a good start. That you don't have IRAs, I understand. I'd be interested in figuring out, at least with you, or maybe you can do this with your accountant or tax preparer, whether you need to be putting in a different kind of retirement plan or some kind of retirement plan. You could do an IRA, but there are a lot of other ways, depending on what your tax liability is, that you guys could sock away a bunch of money. And, maybe what you do is, because you've got some money sitting in cash, you look at one of these plans as a way to really wipe away your tax liability this year, maybe even next year. Maybe you do it right at the end of this year and then again next year. Some of these plans allow you to put in $56,000 each. So you could have $100,000 this year, $100,000 next year, and you could probably wipe away your tax liability for a couple of years. That would be kind of nice. That said, I cannot give you a clear allocation until I really understand what's going on in your lives. Generally speaking, if you want to get the money to grow more, you could simply go to depositaccounts.com and search for some higher yielding accounts. That could be a CD, could be a money market, could be a savings account. If you are really interested in trying to put a portfolio together, then I would encourage you to give us a holler back, because you don't want to walk into some financial professional's office and say, I've got 500 grand in cash, help me. Because I think that could be a recipe for disaster for you guys. You'll probably get sold some annuity or some nonsense. I'm going to encourage you, Susan, to give us a holler back, and let's get some more details, and I can help steer you in the right direction. Ernie wants to know my thoughts on marijuana stocks. Are they worth taking a risk on? Ernie, this is what I would say. What are my alternatives? If you're telling me you want to throw a tiny bit of money, 1% of your total portfolio, you want to throw $1,000 into a pot stock, all right. Or you might say, I want to take $1,000 and go roll craps at your local craps emporium. I mean, whatever you put in it, my thought is be prepared to lose it. Okay? Andrew is 66 years old. He's thinking of retirement. He works. He makes $99,000 per year. Well, that's rather detailed and precise. I like that. He started taking Social Security when he turned 66, almost 67. $2,400 a month. He also receives $140 a month in VA benefits. His wife is retired. She nets $1,170 in Social Security and $1,150 in a pension. That's great. He's got $845,000 in TIAA, which is a provider for nonprofits. So TIAA CREF is usually the company, how it's referred to. Another $250,000 in CDs at 2.4%. He's got $60,000 in cash. He owns his home free and clear. I feel we can live on about $55,000 per year. Do the numbers work to retire, or will I have a shortfall at some point? Mark, do you want to do the math with me? Those numbers work for me. 24, 25, $2,500 a month. She's got this. You got $5,000 a month coming in. Come on. You're in great shape. You can retire. Whether you want to is something else. But absolutely, you've got plenty of money coming in. You've got a beautiful portfolio. Keep working, though, if you like it. It always does make the numbers work really well. Okay. That said, you are listening to Jill on Money. And if you've got a financial question, just give us a shout. Go to JillOnMoney.com. That is our website, and you can click the contact button, or you can email us, askjill@JillOnMoney.com. We'll be right back.
Twitter, Instagram, Facebook, YouTube, she's all over the place. Go to JillOnMoney.com to find it all. Now back to the show with Jill Schlesinger.
You're back. It's Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. And if you're hopping around our website, which is JillOnMoney.com, very easy. All you have to do is click the contact button. It's in the top right. While you are on the website, you can read stuff. You can listen to old shows. You can watch TV segments and videos. Got a great resource section. And please sign up for a free weekly newsletter. Didn't someone just name us as like top newsletter, personal finance or something newsletter? Policy Genius. How about that? Their editorial is separate from their sales. Don't worry. Okay, Michael writes, I live in Anchorage, Alaska. I'm about to retire and move to Utah. I'm 62. My wife is 60. She may retire or work part-time. I have a pension from the military. I also will have one from federal civil service. My goal is to conserve but not preserve money. Ideally, we don't want to leave a lot of money on the table when we die. 2 areas of inquiry. Is it worth hiring a financial advisor? We haven't had one, and we would like to hear your thoughts because we find them expensive. Toward that issue, what kind of equity versus bond split should we consider? And let me just finish. The second part is having 2 government pensions. What kind of distribution should we consider? Okay, here's the thing. Let's go backwards. What you really want to do is first say you've got 2 pensions, right? A military and a civil service pension, right? There we go. And now I need to know, how much money do you need to spend? Will those pensions cover your basic spending needs? And then how much money do you have in other assets? And let's just make up the number. Let's say you had $500,000 in all other assets. And the question is, should you be able to withdraw this, what you call the traditional 4% a year? That's called a withdrawal rate. And I don't call it traditional. I mean, I think that withdrawal rates should probably be closer to 3 or 3.5%, just because I don't think returns are going to be so great. So the question about how to manage the money you have is dependent on how much money you need to withdraw, right? Because that's going to be part of the equation, and how much risk you can tolerate. A financial advisor may be able to help you with that, but it is expensive. So what you may want to do, and this is something that I have right on the resource section, I might steer you towards a planning website called esplanner.com. They will run different retirement scenarios. And I think it's kind of a cool way to play with what your options are. So that's a cheaper way than you hiring an advisor. Now, remember, don't go crazy, because if you're really thinking that all of this seems too much, what it may be good to do is just lay it out. What are the options? And then you can always hire an advisor later, okay? This is from Sandy. Her husband passed away in 2012, no life insurance, which stunned me, she says. In order to ends meet, I used a few credit cards. Some have high interest rates, 26 to 28%. I've been receiving a lot of junk mail from companies about debt consolidation. And until I read the fine print, they seem really good. I tried going to my local bank to get a home equity loan. I've been turned down because my debt-to-income ratio is too high. I've pulled my credit score up from 580 to 700. I stopped using plastic 3 years ago. Can you recommend a good way for me to consolidate this mess? Yeah. How about this? You know what? We have a podcast sponsor, Marcus by Goldman Sachs, and they offer installment loans for people just like you who are basically credit worthy but can't quite get all these bills paid down. So go to marcus.com. Try that out. I think that might work for you. Okay? College savings question. I've been listening to your show. Thank you so much for the advice. I'm 36. My husband is 41. We've got 2 small children, 4 and 2. We live in Connecticut. We've got $15,000 in an emergency reserve fund, a small investment account from an insurance payout I received a few years ago. Our only debt is a small mortgage. I max out my 457 plan. My husband maxes out his simple IRA. He's been saving for quite some time, so has a much larger reserve built up at this point. We also both have Roth IRAs, which prior to children we were maxing out as well, which brings me to my question. We use the Connecticut Higher Education Trust, the CHET plan. It's a 529 plan. Under Connecticut state law, we're able to claim up to $10,000 of any CHET deposits, which are after tax, as a state income tax write-off. We don't presently have enough extra money to fully fund both our Roths and fund 10K into the CHET accounts. Where should we be putting our money to get the most out of it? It was our understanding that the Roth could be used for college savings or retirement, whereas the CHET must be used for education. Would you recommend funding the CHET and taking the state income tax write-off, or funding the Roth accounts to have greater flexibility? I think split the difference, really. I mean, I love the idea that you have a lot of money saved. I think it's great. Split the difference. I like using 529 plans, tax-free. It's easy. I probably would want to know a little bit more about how much money you both have saved before making that a definite, but that's my first instinct, okay? That's it. All right. If you got a financial question, ask Jill at jillonmoney.com. We'll be right back. You're back, and before we close out the show, I just want to remind you we are broadcasting live from the Policy Genius studios. Policy Genius is the easy way to compare and buy insurance. Go to policygenius.com. Hey, you know what? September is Life Insurance Awareness Month, so perfect time for you to go check out whether you have enough insurance or the right kind. Now, gang, sometimes you send me these ranty emails that crack me up. Sometimes I get really mad when I first read them, but now I actually am smiling. Here's Barry. Dear Ms. Schlesinger, first off, let me start by saying I'm a saver. I'm one of the few people in this country that didn't put it into the sorry-ass state of affairs that it is in. Yes, you alone are that guy, Barry. Goes on, didn't use our home like an ATM. We didn't buy crap we didn't need. We didn't buy or lease a new car. And so we would search for things that, whatever. Savers are, and this is what his nut is. Savers are the most screwed segment in this country, which brings me to the reason for writing this email. By the way, guys, the fact that I'm actually reacting to this is hysterical because here, I don't know why you think this is the best path to take when writing about this. Here he goes. Are you kidding me about the past few years as being good ones for savers? What planet are you from? We've been getting the crappy end of the stick since 2008. Do you honestly think 2.5%, 2.75%? If you're extremely lucky, maybe 3%? That doesn't even cover inflation. By the way, 3% is a dream now. Most of the institutions rolled that back right after the last Fed cut. But wait, there's more. For all those people who are living way beyond their means, they're going to get a break so they can roll up more debt. How convenient. Ms. Schlesinger, I can tell you now that this country is in some kind of serious danger. Blah, 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 blah. He makes a bunch of political stuff. Then he says, sorry about the rant. Are you? You're not sorry because he sent it. Okay, Barry, calm down. First of all, you can still get. I'm literally on the depositaccounts.com website where for 2-year CDs you can get 2.8, 2.75. Second of all, the inflation rate is below 2%. And the last thing is, you know what? You took no risk and you're a saver. Good for you. Why are you so mad? Why are you so mad? Don't be mad. Everything's okay, Barry. Okay. You've been listening to Jill on Money. Save your rants for your friends on the weekends, but do send us emails whenever you get a chance throughout the week. We always check the email inbox. Ask Jill at jillonmoney.com. Have a great rant-free week. We'll see you next week.